America is home to 33 million small businesses, the beating heart of communities across the country.
And proof that the American dream is still alive.
This is a show about those dreamers and doers and the communities they serve.
Their real life stories.
Their struggles and successes.
Their grit, determination, and passion.
And the people who fight
to keep their American dream alive.
I'm Alfredo Ortiz.
I'm Elaine Parker.
And it's time for another episode of Main Street Matters,
America's small business megaphone. Hi, everyone, and welcome back to another episode of Main Street Matters, America's small business megaphone. I'm Elaine Parker with the Job Creators Network, and today we're joined by Tracy Byrnes, a seasoned financial expert, former Fox Business anchor, and author of the book, Deduct Everything. I love that title. With decades of experience in accounting, investing, and personal finance, over 200 tax strategies packed into her latest book, Tracy is helping Americans and small business owners legally minimize their tax burden and maximize their growth. Welcome to the show, Tracy.
Thanks so much for having me.
Well, I know before we came on, we were kind of talking about the big boogeyman at the IRS. But I've actually called them before and had a question. I have my own LLC and talked to them. And I have to say, the IRS agent I actually spoke with was concerned about my perception of him. I can remember him saying, I want to take the time and spend time with you and answer your question. A lot of people think we don't take time with people. And I really want to spend time answering your question. And I was so floored by it. Because as you and I were saying before we hit record, I think people are happy to leave money on the table as long as the IRS doesn't notice them. So how did we get here with the IRS in terms of people walking away from money on the table just to not be noticed?
I love that you just said that. And I hope we perpetuate that conversation because there is this doom and gloom. You know, we have this like evil Uncle Sam caricature in our head that's, and he's going to come banging on the door, take our children and the dog because we deducted something incorrectly. And it's just not that way, right? I think even if something was wrong, even if you got audited, it's okay. You're going to show some documentation. It's a pain in the neck. But at the end of the day, if you just have a nice little conversation with the IRS, it will work out and you'll move on. You do not have to be thrown in jail if you're audited. Like, let's just be clear about that. I think like over the years, you've had people like Wesley Snipes who have said, I'm not paying. And they've made it so scary and frightening and evil. At the end of the day, part of the reason we pay taxes, right, is to supposedly help our economy, help our government, help the streets, the roads, the things we use all the time. We can get into a whole conversation about whether or not that money's being used for that stuff, but it's not an optional system, right? You have to pay in. And the easier we make it, the smoother we make it, the better off we all are.
Well, I mean, I think, and this is my experience with small business owners, because I talk to small business owners every day at Job Creators Network. It's who our audience is. It's who we talk to. It's who I work with, who I advocate for every day. And I think the fear is when the IRS comes a-calling that it's not like the legal system where you are presumed innocent unless they prove you guilty, right? I feel like the perception, and tell me if it's wrong, is that when the IRS comes calling, you are presumed guilty until you prove yourself innocent. So why do people have that perception, and how do we kind of make people feel more empowered?
I think because the IRS feels scary. I think because the tax code is confusing and convoluted, at least maybe in the legal system or right from wrong in the law, it's so much harder to know right from wrong in the tax code because it has become the world's biggest book of favors. So who the heck knows what goes on in that thing unless you can hire high-powered attorneys to dig deep and things like that. Maybe that's why. But even if the IRS asks and says, we think you owe this, you paid this, they have been wrong. I remember getting a letter from them saying I owed X. I showed my stuff. We settled on a number. I did not pay what they thought I was supposed to pay. And there have been over the years cases too, I have heard, where people thought they were being targeted, right? There were targeted audits coming out of the IRS. We've heard all these terrible things, but that is in the small minority. The majority of the experiences are probably much more like yours. Let's not be afraid of this. Let's empower ourselves because if you have documentation to prove what you're taking, take it. Let them come ask for the documentation. It's fine. It's a little time and energy and maybe a little annoyance, but it's yours. It's right for you, rightfully yours. So fight for it.
So there has been a lot of tax changes, I'd say, over the last decade, which I believe were good things. The Tax Cuts and Jobs Act, I think, was a great revision of the tax law. I think that we hadn't changed the tax law substantially in 30 years. I think there were a lot of very good reforms in there, particularly focused on small businesses. And then last year, of course, the big beautiful bill, or whatever they want to call it, the working family tax credit, they keep changing. I like the big beautiful bill personally. It's easy to remember. It codified and made permanent all of those lower tax rates, brought back immediate expensing for small business owners. And I know that immediate expensing had phased out, and I talk about it a lot on this show with small business owners. But tell us in real terms, like, what does that immediate expensing really mean? Because it sounds so wonky when you start talking in tax terms, but like, lay out what immediate expensing means for a small business owner and how it's such a game changer.
It's huge. Okay, so let's just say, for argument's sake, you bought a product that's $1,000. In the past, we're going to be very simple here, right? We're going to say in the past, you could only expense 25% of it every year. Again, that's not true, but we're going to make simple examples here. So every year you get to negate $250 off your tax bill. 250, 250, 200, 4 times. Now you get to take that 1,000 all right now. And that's huge because it's today. And then next year you can go out and buy something else and take all that again today. And I think it's huge, and it encourages investment in small businesses. I will say the big thing, this one big beautiful bill act did is so much for small businesses and encourage investment in small businesses even more so, right? I think that's one of the best things in this bill. Yes, there's no more sunsets on estate planning and all the things, and we could talk about all that. But I actually appreciate the most what it has done, what it's doing for small businesses. And that immediate expensing is huge. You buy a computer, you get to deduct it all today. Take it, expense it today. Make sure that hits your Schedule C or whatever the heck you're filing. But think about all the things you purchased. Tell your preparer, or if you do what I do, I use a software. Take your time and answer all the questions, and make sure you deduct and expense what you deserve.
So you use a software. That's interesting.
Do
Do you feel like the tax code, as a result of those two pieces of legislation in the last decade, has gotten more simple, that small business owners, won't leave as much on the table and don't need to go to an expensive accountant and spend thousands of dollars?
Well, so no, I think you just need more patience. I always say, pour your drink of choice when you sit down to do these things, because it's going to take a minute. It's going to take a minute. And then the best way to use these products is to not skip around and think you're smarter than it. I still answer every stupid question. Did your address, even down to that, did your address change? Who are your dependents? Check your social security number. I start from the beginning and work my way all the way to the end to make sure that I'm not missing a thing. I think that is the way to use these products. Nowadays, some of these products actually have live people that will zoom on into your tax return and help you figure stuff out. I have used that aspect of it as well. They're very helpful. And I know my way around a tax return, and I still am using these people. So I think there are a lot of ways to empower yourself and get it done. Understandably, though, a small business could get very complicated, right? But if there's a point in your life where you have a somewhat simple tax situation, I actually think it's a really good exercise to just try to do your own return, because it just gives you a sense of what it is, why your tax preparer is asking for certain things. It's really just a big mathematical equation at the end of the day. I pray and wish that Congress someday gets takes a shot at doing their own tax return, because then they'll have a better sense of when they're making rules, because some of them are almost impossible to implement. And so I think it's a really good empowering exercise for people, and the products have come a long way.
Mm-hmm. So your book, Deduct Everything. What does that actually mean legally?
So I think if only that it was a bigger book, the title would be Deduct Everything You Legally Are Allowed to Deduct, right? You and I were talking off camera. People leave money on the table because they're afraid. But if you qualify, if you have the piece of paper in front of you to show that this is legit, take the deduction. People are afraid to take the home office deduction because everyone says it's a red flag. But if you have a home office and the door shuts at night and you walk out and no one is playing, with their little toys on the floor during the day, it is a home office. Take the deduction, right? Things like that. Like if you're charitably inclined and you drive to that church picnic with a casserole in your hand, that means you can deduct the miles on the way there, the ingredients in that casserole. Take it. Take everything you are legitimately allowed to take. It bothers me that people leave money on the table because they're afraid. We shouldn't be afraid. And if I could do one thing, it's like somehow get rid of the scary Uncle Sam caricature in people's heads.
Yeah, exactly. Um, the home office deduction, yes, that is what I've been told too. It's a red flag. It's not worth it. Let's break it down on what it really means in terms of a dollar figure and why it's not worth the deduction. And so I walked away from it. I was like, oh, okay, why raise any red flags to have that mean old caricature from the IRS call me then?
But especially nowadays, so many people are entrepreneurs, and I love it. Women, especially, are entrepreneurs and they're making it happen and they're working from home. If you have a legitimate space in your office, the big thing is a lot of people say they have a home office and their computer's on the dining room table. That's not a home office, right? And by the way, the IRS will eventually say, "I'm going to come look at this home office." So that you're going to have to move your kid out of his bedroom and set something up real quick. But if it's a legitimate space, if you do not have an office somewhere else, that's part of the problem too. I think people push the envelope a little bit. If you work for a company and you have an office there, you cannot take a home office deduction as well. You're taking a home office deduction because you have no other place to work. If that's the case, and again, we are in this entrepreneurial gig economy, a lot of people probably do have home offices. Take the deduction.
Okay. What do you think is the one deduction that experienced accountants overlook?
That's a great question. I think the big thing now going forward, because the standard deduction has gotten higher, is for people and their preparers to talk about bunching deductions. It's like quirky, but there's planning here now. The standard deduction is higher, which is great. So that saves you the nonsense of having to fill out that Schedule A, right? Write off tally your charitable contributions, tally this, tally. But if you're in like a high state like New York, New Jersey, Connecticut, California, you can qualify for that SALT deduction now. So, but you have to itemize to get that SALT deduction. So if you can get that $40,000 in that year, you also should maybe think about, you know, throwing as much money out to philanthropy as you can. Get your charitable contributions in the year you're reporting all the things on your Schedule A. Try to think ahead, because maybe then the following year you're not going to qualify and you're going to take that standard. And you want, not that we want to jib charities on any level, but you want to make it smart too. So think through the bunching. I think there's more planning now involved as a result of this One Big Beautiful Bill Act than ever before.
Oh, that's interesting that you would say that. SALT deduction lets state and local taxes. So in the initial Tax Cuts and Jobs Act, it was taken away. In the negotiations, it's now, you said 40,000.
Or One Big
40.
Beautiful Bill Act, it could rise 40. But of course, like all things, there's an income limitation. If you make too much money, you don't get it all, or it starts to phase out. So so it's like all these things, even, we can talk about tax on tips and tax on overtime. All that stuff is phased out when you hit a certain income level. So I love that people say, the rich get away with murder. Yeah, maybe, but they don't get any of these deductions. They AGI right out of them. They make too much money to qualify for all this stuff. So they really are carrying the load of our tax revenue, quite frankly. But for those middle income families, especially families New York, New Jersey, Connecticut, that are like putting kids in school and trying to get it done, the SALT deduction is huge sense of relief, at least for the time being.
What about for people who think that that's sort of the rest of the country that doesn't have state income taxes, other states or have lower taxes are subsidizing those high tax states? What's your thought on that?
Yeah. I mean, but just, yeah. But I live in
Yeah.
New Jersey. It's ridiculously expensive to live here. And if, as I said, it's a book of favors, right? The tax code. This was a favor to all the congressional people in those states because they are hanging on by a thread trying to keep residents in. Otherwise, Katie bar the door on Florida, Texas, Wyoming, because we're all coming. Because it is very difficult, especially for our kid, like the young people coming up the ranks, like, kids getting married. They can't afford to live here. It's terrible. So the population is shrinking in these states. It is, again, a favor to those states, to those constituents, to try to keep them there. Otherwise, Jersey's in the house in Florida. Beware.
Well, I'm down here in Florida, so I can tell you we see a lot of people from the Northeast moving up here.
Right.
All right, let's walk through some of these. Explain that 20% tax deduction. I always called that sort of the third. We created like a third tax class when that passed because we had single filers, married filers, but now we have a small business tax class. Explain how that works. It phases out too, right? Then it's specific to industries.
But right, but man, if you qualify, that's 20% just out the door. It's brilliant. Again, this was something in this One Big Beautiful Bill Act that I think solidified. It's here now. People should take advantage of it. Make sure you ask that question. You don't need to know how to do the calculation, right? But ask the question to your preparer. Do you qualify as a small business for that 20% deduction? Also, too, consider, I love that they put qualified small business stock in the One Big Beautiful Bill Act, too. And not that they put it in, but they extended the rules around it and made it so much more appealing. So if you're a small business looking for investors and you issue out qualified small business stock, you have to be a C Corp to do this. But there's a possibility that the investor receiving that stock could not have to pay capital gains tax 5 years later. So you get an investor to invest, you give them qualified small business stock, they stick around for 5 years. Any gain, and God willing, it's a lot because you want your business to kill it, any gain will be capital gains tax free. It's beautiful and it encourages investing. This is the one thing in the One Big Beautiful Bill Act that if I could put on a banner and wave a flag around to small businesses, like think about this, think about issuing this if you are looking for investors or you have family members or whatever, but then the gain could be capital gains tax free. It's amazing.
So I've always been curious on tax structures. Is there a difference in tax strategy with an LLC, an S Corp, sole proprietor, C Corp? I have an LLC I live in Florida, so I have an LLC, and then I have an S Corp for the federal filing of tax purposes. I don't have to, but I do file as an S Corp for federal income taxes. But when I talked to the IRS, the one time they were so nice to me, they said, we don't recognize LLCs at the federal level. And so I found that interesting, nor did I even understand it. But is there a tax strategy between the different structures? Is one better than the other?
So the LLC and the Schedule C in their brain is kind of the same thing. So that's why they say they don't really recognize it. It has the same tax benefits, the same whatever. Legally, the LLC has more protection, right, than putting it on your Schedule C. and your regular personal tax return. But as far as the tax benefits, that's, I think, probably what they were alluding to. Yeah, the C Corp is the safest you could go, right? You create a corporation. God forbid anything. I'm Italian. I say God forbid a lot. God forbid something happens. It doesn't hurt. It doesn't touch your personal, your family, nothing. I mean, that's why we create these structures, right? To put stuff in these little shells and say, if something happens, you cannot to my business, you can't touch my family. That's really what it's all about. And so, you know, shell of choice, up to you, your attorney, your accountant, but it's about protection and taxability. Many will argue that a C corp more expensive to maintain, admin, create the tax return, things like that. But depending on the size of your business and whether or not you want to offer qualified small business stock, a C corp could be a really sound legal entity, depending on your situation.
Where would you say you really only need to be a sole proprietor, DBA, you don't really need to set up a structure? I mean, how simple of a business would it be? Is it a revenue issue, like a size of your revenue, or the complexity of the business?
Yeah, I guess it's a little bit of both. I mean, and again, we start to separate when we think there's legal issues or when things are getting hairy, or better yet, you want to take on an employee and things like that. So when you're starting out, you're a little gig economy, you're driving or you're selling your stuff on Etsy. I think that Schedule C is perfectly fine. But if the business gets big enough where there's money involved, there's clients involved that could be mad at you, there could be lawsuits, you never know. I think that's when you start to really think about removing it from your personal tax return.
So you mentioned you're in New Jersey. I know that there's a lot of issues around the cost of energy. I know energy has skyrocketed. Um, what? How can small businesses take advantage of energy credits or other government incentives like that?
So the one thing the one big beautiful bill act did not do is update those, but that said, there's existing, right? Solar panels, energy efficient windows, things like that. Put them on your warehouses. All that stuff is still there for you to deduct and take. There's that one time, or new, I should say, $10,000 car loan interest payment. So if you buy a new car for your business, it has to be an American made car, it cannot be used, and it has to be a brand new American made car. But you may be able to deduct up to $10,000 of interest on that car loan. So that's something too that can help them. Energy efficient cars still out there as well. So they're all still there. They weren't updated or changed or anything, but that stuff is still there. And again, you should take advantage of it if you can.
Actually, I'm glad you brought up the car loan. Is it American made or American assembled? And the reason why I ask, and maybe I can say this on air, is I bought a Hyundai last year, and I know they're assembled in the U.S. And I got the statement to deduct the interest, which I didn't think I would qualify for. So I wonder if it's American assembled.
You're probably right then. I think the rules are fluid. I think the IRS, and this is what I was saying earlier, Congress creates the rules and then they hand it to the IRS and they say, here, implement it. And it becomes very difficult. So if you have the proof, you have the form, you should deduct it. And I hope you did.
Oh, I
Um,
did.
oh, good. Good. then the story's over.
Absolutely, I did. So if you're going to buy a car and you want to make sure that you get the deduction and you don't necessarily find one that's American made that you want, but you know it's assembled, I think you might get the deduction anyway.
I mean, that's a great tip, actually. People then should ask at the car dealership where their cars are assembled. Um, I had my boyfriend tried to put a Range Rover through, and they were like, "Yeah, no shot." So that if I know that much.
I was surprised personally because when I heard it go through, I thought, well, that's interesting because cars are really expensive nowadays.
I
Even when
know.
you're buying Toyotas and Hyundais, it doesn't have to be the BMWs and the Mercedes. I mean, cars are just expensive,
Right.
and so to be able to, and the interest rates were so high.
Right.
They've come down somewhat, but they were so high last year when I was looking, and it just was unfortunate because literally a month later they did no interest on car loans, and I 30 days. If I had just waited 30
That would be
days.
me too. Yeah, that would be me too. They like jack the interest rates up when I walk in the door. So I
Yeah.
get that.
Are there smart ways to turn everyday expenses into legitimate deductions?
Well, um, that's I guess back to the charitable giving stuff. If you're, making brownies for a school picnic or something, that is in theory a charitable donation. So keep track of all that little stuff. Um, pay attention to your home. Make sure you're calculating real estate taxes, mortgage insurance. People forget about if you refi and you have points, don't forget about all those things, all those day-to-day things that surround your house. As I mentioned, the solar stuff, if you updated, put windows in, put solar panels, all that is could be included on your tax return. Don't forget that. I would also say pay attention to um, all the little expenses you incur to keep for in your small business. Like, so that's marketing, advertising, entertaining clients. Keep really good track of all that and digitize it. The IRS finally is modernizing and does not want you to bring in a shoebox full of receipts. So have electronically save everything. There's apps all over the place. I use an expense app and take a picture of a receipt after I take somebody out to lunch or dinner as a client. It's there now forever. If anybody needs proof, I have it. So I would make sure you have that all lined up. And I would say, let's start using our tax return as a planning vehicle for next year. Everyone like the April 15th comes, we sign and we're like, praise Jesus, we don't have to worry about this till next year. It is a really cool, dare I say I'm such a dork, but it is a cool document to look at to plan ahead. Are you getting money back? Shame on you. Do not let the IRS or the federal government play with your money all year long. Your goal is to be net zero. So if you are either your estimates were too big or you're having too much money withheld, scale it back. You do not need them to have your money all year long. If you owe a ton, though, the reverse is true. You don't want to be stuck unless you're okay with that. That's okay too, as long as you're not incurring underpayment penalties. But use it as a planning tool for next year. What can we do? And at this point, too, if you took the standard, but you think maybe next year you're going to have some big charitable contributions or something like that, think about bunching them. Think about maybe prepaying some things just to get that Schedule A all beefed up so you get a bigger deduction and then you flip back to the standard.
It's interesting you mentioned the paying too much or paying too little. I know people on both sides that are thrilled that they're getting,
I know.
$3,000 back. And I know people who say, I don't care that I have to pay 20 grand as long as the government didn't have my money all year.
Mhm,
And I just think if I'm plus or minus like 1,000, I'm so happy. I'm jumping
mhm.
up and down. It means I have planned perfect.
I agree. I 1000% agree. And kudos to you if that's where you're at. My daughter owed $80 and no, she was getting $80 back and she was flipping out that she was so upset. I said, you win. This is a W. You planned it perfectly. You did all the things. Like this is the goal. And I think more and more, I think a lot of people use their refund as now we're going to go take a trip to wherever. But I would rather you put that same exact money aside then. Put it aside in a vacation fund. Keep your own money. If you are being over withheld, why don't you then take the amount that's being over withheld now, keep it, put it in something, and then take the family away. At least it's yours.
Okay, last question. If you could give Main Street business owners one piece of tax advice, what would it be?
Other than deduct everything you're legally allowed to, be very careful with the tax on tips. If you own a beauty shop or something like that where there's tip money that comes in, tips are not tax free. Please report them all and then see if you qualify for the $25,000 deduction. That's very important. I think the media is blowing that out of the headline out of the water on that. It is a deduction. It's not a freebie. So report it. Pretend again, depending on your income limits, you may or may not qualify for a $25,000 deduction. while not necessarily for small businesses, but same with overtime. So for all our police officers, firefighters, EMT workers, report your overtime, then see if you qualify for the deduction. Don't just not report it. They will come back to you and ask you to pay tax on that money eventually. But small businesses, ask your preparer about the 20%, the qualified small business stock, and just document everything and take as much as you can. You deserve it. You work hard.
Okay, I lied. I have one more question. Where can people follow you on social media, and where can they get your book?
I love it. Thank you. The website is Tracy Byrnes Wealth. It's Wise, TracyByrnes Wealth. And I'm at Tracy Byrnes on LinkedIn. The book is on the website, but it's also on Amazon.
Well, Tracy, thanks so much for taking the time to join us today on Main Street Matters, America's Small Business Megaphone. And thank you all for taking the time to tune in. Main Street Matters is part of the Salem Podcast Network. New episodes debut every Wednesday and Friday. You can subscribe to the show wherever you get your podcast from, and we'll be back soon with another episode.